Everyone says gold is the safest place to be. But what if that belief is exactly what could hold you back in 2026? Because while gold protects wealth, silver may be positioning to outperform, and most investors aren't paying attention. All right, let's get right into it. We're going to build the decision framework for two of the world's oldest assets, gold versus silver. The big factors that are going to drive their prices in 2026 are already moving, so let's break it down. You know, when you think of a safe investment, what's the first thing that pops into your head? For most of us, it's gold, right? When things get crazy, that's where people run. But the whole landscape is changing, and just defaulting to gold might mean you're missing a huge part of the story as we head towards 2026. And really, this whole debate boils down to a core conflict between two totally different goals. Are you trying to preserve your wealth, an anchor in the storm, or are you hunting for growth potential, the engine that could power your portfolio forward? That right there is the fundamental choice between gold and silver. Okay, so first up, let's talk about gold. The best way to think about it is less like an engine and way more like an insurance policy. But its role is, well, it's evolving, and it's absolutely crucial to understand how. Now take a look at this. This chart basically shows the old rulebook for gold. For the longest time, the relationship was pretty simple. When the blue line, which is real yields on bonds, went down, gold, the yellow line, tended to go up. Why? Well, because the cost of holding an asset like gold, which doesn't pay you anything, drops. It just looks a lot more attractive. But here's where things get interesting. As this research from the University of Malta points out, since the pandemic, that clean, simple relationship has gotten, well, pretty messy. There are new drivers in town. Things like pure safe haven demand, real fears about inflation, and just general geopolitical chaos are now pushing gold's price around, sometimes completely ignoring what interest rates are doing. So what is gold's job today? Think of it as a three-part insurance plan. It's your safe haven in a crisis, it's a hedge if your currency weakens, and it's a diversifier so not all your eggs are in one basket. At the end of the day, it's meant to be a stabilizer, the calm in the storm. Okay, now let's pivot to silver. If gold is the insurance, silver is the industrial engine, and its story is all about exploding demand running headfirst into a serious supply problem. This one number from the Silver Institute says it all. 5. For 5 straight years, the world has been in a structural silver deficit. We're using more than we can dig out of the ground. This isn't just a temporary thing, it's a fundamental market imbalance that's putting a constant squeeze on supply. And a huge piece of that demand story is coming from the green energy revolution. Solar energy alone now eats up a massive 14% of all silver consumption. As the world keeps pushing towards decarbonization, silver is becoming absolutely essential. It's basically irreplaceable in a lot of this high-tech stuff. And get this, it's not just that we're building more solar panels, it's that the technology is getting better. And as we move to more efficient cells, from PAC to TOPCon to HGT, the amount of silver needed in each and every panel actually goes up. So better technology literally means more demand. It's a powerful multiplier effect. But of course, there's no such thing as a free lunch. Because silver's fate is tied to both investors and the swings of the global economy, its price chart looks a lot more like a roller coaster than gold's. These big swings make it a classic higher risk, higher reward asset. It's definitely not for the faint of heart. So how can you even compare these two directly? Well, one of the most popular tools is the gold to silver ratio, but you have to see it for what it is. It's a signal of relative value, not some crystal ball that predicts prices. The definition couldn't be simpler. If the ratio is 80 to 1, it literally just means it takes 80 ounces of silver to buy 1 single ounce of gold. It's a direct snapshot of how the market values them against each other at that moment. And what's really useful is that historically this ratio has tended to hang out in a range, usually between 50 and 80. So when it spikes way above 80, it's a hint that silver might be looking historically cheap compared to gold. And when it drops below 50, it suggests the opposite. So this leads to a pretty critical question you should ask yourself. When you see that ratio sitting way up high, let's say 90 to 1, what is that actually signaling? Does it mean gold is overvalued? Or does it mean silver is just an incredible bargain? It's a prompt to dig a little deeper. Okay, so let's tie all of this together into a simple framework for 2026. Because again, the choice isn't about which metal is better. It's about which one fits your goal. Are you looking for protection or are you looking for potential? So here it is, the final breakdown. Gold is for preserving what you have. It's for reducing the crazy swings in your portfolio. Silver, on the other hand, is for tapping into huge industrial growth trends. It's the higher risk option for that higher reward potential. It's that simple. So, at the end of the day, the decision is yours. It really depends on your own outlook and what you're comfortable with. So I'll just leave you with this question. If you had to choose just one for 2026, would it be gold or would it be silver? If you appreciate these calm, research-based breakdowns that just cut through all the noise, we'd love it if you'd subscribe and join us for the next one. Thanks so much for watching.